Last week, we built Marcus's budgeting system. Now comes the question almost everyone asks. I've started saving money, but where should I actually invest it? Maybe you've heard people say, buy stocks. Others say, invest in real estate. Some tell you crypto is the fastest way to get rich. And then there are people who tell you to keep everything in a savings account. So who's right? The truth is, choosing the wrong investment can cost you years of progress. But choosing the right one doesn't have to be complicated. Today, I'll show you 5 beginner-friendly investment options, explain the pros and cons of each, and tell you exactly which one Marcus chose to build his wealth. By the end of this video, you'll know where to put your first investment, even if it's only $100. Let's begin. Before we talk about where to invest your money, let's talk about the mistake that traps millions of beginners. They think investing is about getting rich quickly, so they chase the hottest stock, the newest cryptocurrency, or the latest investment everyone is talking about on social media. They hear stories about people turning a few $100s into thousands overnight. But what they don't hear are the millions of people who lost money trying to do the same thing. Marcus never tried to get rich overnight. He focused on getting rich over time. That's a huge difference. Instead of asking, what's the fastest investment? He asked, what's the safest investment I can stick with for the next 10 or 20 years? That single question changed everything, because building wealth isn't about making one perfect investment. It's about making good decisions consistently. Remember this, the best investment isn't the one with the highest possible return. It's the one you'll continue investing in month after month, year after year. That's exactly what Marcus did. Now let's look at 5 beginner-friendly investment options, starting with one of the most popular choices for long-term investors. Let's start with the investment Marcus actually chose. An index fund. If you've never heard that term before, don't worry. It's much simpler than it sounds. Imagine walking into a grocery store. Instead of buying just one fruit, you buy the entire fruit basket. If one apple goes bad, you still have oranges, bananas, grapes, and dozens of other fruits. That's exactly how an index fund works. Instead of putting all your money into one company, you spread your money across hundreds, or even thousands, of companies at the same time. That means if one company performs poorly, the others help balance things out. Over many years, this approach has historically produced solid long-term growth while reducing the risk that comes from relying on a single company. That's why so many experienced investors recommend index funds for beginners. Marcus didn't spend his evenings trying to predict which stock would be the next big winner. He simply invested in the market as a whole, every month, without trying to time the market, without chasing headlines, without panicking every time prices went up or down. This approach may sound boring, but boring is often what builds wealth. Marcus wasn't trying to become rich by next month. He was building financial freedom one month at a time. If you're completely new to investing, an index fund is one of the simplest places to start learning about long-term investing. Our second option is an ETF, which stands for Exchange Traded Fund. Don't let the name scare you. Think of an ETF as a shopping basket filled with different investments. Instead of buying just one company's stock, you're buying a basket that can contain hundreds of companies. Just like an index fund, an ETF helps spread your risk. The biggest difference is that ETFs can be bought and sold throughout the trading day, just like individual stocks. For most beginners, that difference doesn't matter very much. What matters is choosing a low-cost ETF that tracks a broad market index and holding it for the long term. Many people make the mistake of buying and selling ETFs every week, hoping to make quick profits. Marcus never did that. He wasn't trying to outsmart the market. He simply invested a fixed amount every month, regardless of whether prices were going up or down. Some months the market was higher, some months it was lower. But he kept investing anyway. This strategy is called consistency, and over time, consistency usually beats trying to predict the perfect moment to invest. Remember this: time in the market is often more important than trying to time the market. That's one of the biggest lessons every beginner should learn. Now let's talk about individual stocks. This is what most people think of when they hear the word investing. Buying shares of one company. Companies like Apple, Microsoft, Amazon, or other businesses you believe will grow over time. Can you make money this way? Absolutely. But there's something every beginner needs to understand. When you buy just one company's stock, you're putting your trust in that single business. If the company performs well, your investment can grow. But if the company struggles, your investment can lose value. That's why investing in individual stocks carries more risk than investing in a diversified index fund, or ETF. Marcus understood this. He didn't try to guess which company would become the next big winner. He wanted steady, long-term growth, not unnecessary risk. Later, after he had built a solid financial foundation, he considered buying a few individual stocks, but only with money he could afford to leave invested for many years. If you're just starting your investing journey, don't feel pressured to pick the perfect stock. Building wealth isn't about finding one magical investment. It's about staying consistent with a strategy you understand and can stick to for the long term. Our fourth option is one that many people overlook: cash savings and government bonds. Now, these aren't designed to make you rich quickly. They're designed to keep your money safe. Think of them as the foundation of your financial house. Before Marcus focused on growing his investments, he built an emergency fund. Why? Because life is unpredictable. Cars break down. Medical bills happen. People lose their jobs. Unexpected expenses don't send you a calendar invitation. If all your money is invested and an emergency happens, you may be forced to sell your investments at the worst possible time. That's exactly what Marcus wanted to avoid. So he built a cash emergency fund first. Then he started investing consistently. Government bonds can also play a role. They usually offer lower returns than the stock market, but they're generally less risky and can help balance your overall financial plan. The goal isn't to put all your money in bonds. The goal is to have a mix that helps you sleep well at night. Remember, growing wealth isn't only about earning higher returns. It's also about protecting the money you've already worked so hard to save. Marcus understood that. That's why he built his financial house on a strong foundation before reaching for bigger returns. So, if you had your first $100 to invest today, where should it go? If you ask 10 people, you'll probably get 10 different answers. But if Marcus were sitting here today, his answer would be simple. First, build your emergency fund. If you don't have at least a small financial cushion, make that your first priority. Once you have that foundation, start investing consistently in a low-cost, diversified index fund, or ETF, that tracks a broad market. Don't wait until you have $1,000 or $5,000. Start with what you can afford, whether it's $20, $50, or $100 a month. The amount isn't what matters most. Consistency is. Remember, Marcus didn't become financially secure because he made one brilliant investment. He became financially secure because he invested every month, even when the market went down, even when life got busy, even when nobody was watching. Small amounts invested consistently over many years can grow into something far bigger than most people imagine. The hardest part isn't choosing an investment. The hardest part is getting started. So don't focus on investing perfectly. Focus on investing consistently. Your future self will thank you for it. Let's bring everything together. If you're just starting your investing journey, you don't need to know everything. You just need a simple plan you can follow. Here's the roadmap. Step 1. Know your monthly budget and save consistently. Step 2. Build your emergency fund before taking bigger investment risks. Step 3. Choose a low-cost, diversified investment like a broad market index fund, or ETF. Step 4. Invest automatically every month. Don't wait for the perfect time. And finally, be patient. Wealth isn't built in a week, or even a year. It's built through small, consistent actions repeated over many years. That's exactly how Marcus turned a simple monthly habit into real financial progress. The good news? You can start the same journey today, even if all you have is your first $100. Here's something I want you to remember. The best investment isn't always the one with the highest return. It's the one that helps you stay invested for the long term. Because time is one of the most powerful tools for building wealth. The sooner you begin, the more time your money has to grow. So don't wait until you feel ready. Start where you are. Start with what you have. And let consistency do the heavy lifting. If this video helped you, subscribe to Jennexa and join us on the journey to smarter money habits. Next week, we're exposing 7 money habits that quietly keep people broke. Some of these habits are so common that millions of people don't even realize they're hurting their financial future. You won't want to miss that one. Thanks for watching. I'll see you in the next video.